Global iron ore negotiations started in the early 1980s. Over the past decades, ore prices have been based on long-term contracts between steelmakers and the big three miners, Rio Tinto, BHP Billiton and Vale. Here's Sun Jiayu with more details.
Annual negotiations settle prices for a 12-month period. The negotiating mechanism is based on three principles. The first one is only settling by price instead of quantity. Each year's price fluctuates based on the price of the previous year. The second principle is the negotiation for the next year's price between steel suppliers Rio Tinto, BHP Billiton and Vale, and steel demand representatives, including China Steel, Japan Nippon Steel, and Europe ArcelorMittal. The third principle is called the passive accept principle. That is, as soon as any miner reached agreement with the steel maker, others have no choice but to accept the outcome. The negotiation is divided into two parts, the Asian market and the European market.
The passive accept pricing principle is currently the most important principle. That is to say, other suppliers and buyers would accept the outcome after one supplier reaches an agreement with the buyers. This has been a rule for 20 years.
Since China joined the negotiations, experts say China has passively followed prices already settled. This is because China not only lacks negotiating experience, but also lacks sufficient preparation.
As for this year's negotiation, we are insisting on our own price bottom line, showing our strong attitude. But we probably focused more on the process of negotiation, neglecting to prepare for the others.
Since 2003, each year's international iron ore negotiation has gained public attention. Each negotiation is considered to be long and complicated. Sea freight charges have become a focus of negotiators.
The price we are talking about is a free on board or FOB price. Each year's settled price refers to FOB price of Brazil or Australia. For a steelmaker, he has to consider comprehensive production cost, which includes FOB price, shipping charging fee, and inland transportation fee from port to the factory. In other words, these three costs added together is the production cost of the iron ore a steelmaker has used.
After several years of negotiations, the price of shipping has been a focus of three major suppliers in Australia and Brazil. In 2008 in particular, after Brazil settled the price, Australia's two suppliers, Rio Tinto and BHP Billiton, wanted a higher price, saying it was due to the sea freight fees.
As according to the traditional rules, Rio Tinto and BHP Billiton should have accepted this price after Vale and Nippon Steel reached an agreement. But Rio Tinto and BHP Billiton required the price to be increased as compensation for the shipping fee. Compensating the shipping fee means the fee from Australia to Asia is far lower than that from Brazil to Asia, so they asked for compensation in 2008. But they were strongly opposed by Chinese and Japanese steelmakers.
In a long seesaw process, the negotiation was in a deadlock. At deadline of negotiations in late June, China's Steel had to reach agreement with Rio Tinto. Although this outcome maintained the traditional framework settled on FOB price, the price surging margin was totally not connected with Brazil mine. The traditional passive accept principle collapsed and replaced with one seller and one buyer negotiation mechanism. Based on this reason, although Japan accepted the price offered by the Australian miner in 2009, China still insists their own price target without concession. That is why the negotiation was postponed until now. Sun Jiayu, CCTV.